Today I have a very special guest who is a tax advisor called James Cannaford, based in Hertfordshire. Welcome, James. I'll
Hi,
welcome.
Charles. It's great to be here, and hello everyone who's listening.
Great. I met James through Business Buzz. They're a networking organisation based in Hertfordshire. I run my own meeting in Watford, and James is I think they call them buzzers, right? We're called buzzers.
Yeah, I think that's what they're trying to get us to refer to ourselves
Doesn't
as.
sound quite right to me, but I know that you've been working in tax for nearly 15 years in a boutique firm and a member of the Association of Taxation Technicians for 13 years. And you've worked as a junior partner within the firm and shouldered much of the day-to-day advisory work. You said you played a pivotal role in expanding the services provided to planning and support for a wide range of sectors and individuals, including landlords, which is of interest to a lot of our listeners, and other accountancy firms, while maintaining a specialism in tax investigation. So if you've been investigating for tax, maybe James is your person. But in 2021, you branched out on your own and you set up your firm, Hawthorne Tax Consultancy. That sounds very traditional, actually. Sounds great. And your website is hawthorneconsultancy.com. And I'll put all your details on the description. But first of all, how are you finding things since the autumn statement, James?
Well, I think there's been I think you would have had to have been living under a rock to avoid a lot of the naysaying and everything that we've heard from the papers. Obviously they've got to sell a lot of online websites as well, trying to doom and gloom it all in that respect. I think that the autumn statement lacked in a number of areas. I think Jeremy Hunt could have really produced a good statement to talk about how an tax system for the 21st century, and I think rather he's just decided to sort of kick it down the road a bit for the hopes that maybe they can land it in the next government's lap. You can see that from where a number of the rates and everything have been frozen for a couple of years. It would land, if the Labour Party do take over, it's going to land pretty much squarely in their lap to have to raise taxes, which is obviously a good campaigning point and politically speaking a good tactic in that respect.
Yeah, so a lot of it is down to changing thresholds, right? Thresholds and freezing the rise in the threshold. So eventually people will reach higher rates of tax much faster. Is that right?
So yeah, a lot of it has been referred to as what is this stealth tax almost. The freezing of the income levels, the 20% rates, the dropping of the 45% additional tax rate down to £125,000. They're all geared towards catching people. We all hope that our income's going to be going up each year. If we're landlords, we're hoping our profits are going to be going up each year. If we're just a normal PAYE individual, normal employee, we're expecting our pay rises going up each year. And rather than sort of actively increasing tax, what the government's done is made it so that more of that tax that we are, or more of that earnings that we're receiving, is going to be caught at those taxable rates. There have been reductions. It would be wrong for me to say that there haven't been sort of reductions in some of these allowances, but if we are looking at sort of the capital gains tax rates, that's been dropped down to around £6,000 from April 23, and then it's going to be dropped down to a further £3,000 from April 24. Likewise, we've got similar step downs with the dividend rates from 2000, or dividend exemption, I should say, from 2000 to 1000, and then 500 to tally in with that. But interestingly enough, although those rates are going down, if we're looking at the type of people that they're hitting, and that being those people who hold wealth, they're not necessarily employees, but they might be individuals with large property portfolios or large investment portfolios. They are probably in a position where they're going to be able to weather the storm. And looking at looking at 300 extra quid out of your investment portfolio because you've lost £1,000 of taxable dividends, looking at selling a property and potentially having to suffer an extra £1,600 in tax. When you're looking at the value of these assets that are being disposed of, they're not absolutely massive. And the tax, the tax grab on those isn't actually massive compared to when you look at employees. And how much they're going to be hit, especially those employees who are earning over that 125.
Yeah. So Can we go through the capital gains in a little bit more detail? I know that there was a figure that
we can.
85,000 landlords had sold their properties over the last few years, and we hear anecdotally that a lot of landlords are sort of fed up with the regulations and they want to sell, so they are going to pay a little bit more tax. And how's that going to work? Because they've reduced the thresholds. Can you explain that in more? And capital gains tax, by the way, is a tax paid on your profit, right?
So it's paid on your gain. Another word for that could be profit, but it's calculated. It's not necessarily strictly that profit of that sale, because there are various exemptions. If you've lived in the property for a period of time, you may be able to claim exemption for those years that you've lived in it, and everything else. So because it isn't a trading asset, it is considered as a gain on an asset in that respect. So at the moment, we are looking at the first £12,000 thereabouts of gain being tax-free. So, provided you've made that disposal, provided you haven't gone over that initial annual exemption threshold, then
no tax.
Then no tax whatsoever. It's a little bit over 12,000. It's about £12,300, but for the sake of conversation, let's say 12.
Yeah.
From April next year, from April 2023, that will be reduced down to £6,000, which of course obviously means that it's going to have sort of a double impact for those individuals who are going to be having those large gains over the 12,300 anyway. More of that gain is going to be caught. An additional £6,000 of that is going to be caught, and is then going to be taxable. The people who's really good. Sorry. At what rate? Well, that depends on what your other income is. The way the capital gains works is it's dependent on your other income band. So taxable gains of up to the basic rate above the 12,300 will be taxed at 10% or 18% if it's residential property, and then above that it's 20% or 28% if it's residential property. You've got to remember the big problem with residential property at the moment is it is suffering that higher tax rate. It's almost double. Capital gains tax on it is almost double, 18 compared to 10, 28 compared to 20 in that respect, as opposed to other investments like dividends and shares and all that kind of stuff.
Right.
So where they're really going to hit, though, are those people who have been able to be clever with their gains and clever with their capital disposals to keep it below that sort of 12,300 limit. People who are going, well, I'll sell 10,000, I'll make a 10,000 gain this year, or I'll make a 12,000 gain this year, and of course that's not being taxed. The government's intention obviously is to start taxing that, and from April 23 it'll be dropped down to £6,000 that's tax-free. So that additional amount above, that additional 4 to 6 is going to be taxable, and then from April 24 that's going to be dropped all the way down to £3,000. As I said, if we are looking at larger disposals, so we're looking at property disposals, residential property, especially the rates at which they've gone up, and the prices, the sales disposals of some of these, losing that £6,000 is really only going to equate to around 1,600 quid more tax. Now, yes, it is more tax. Don't get me wrong. I'm not saying you're going to get away with nothing, but given how expensive it already is to buy and sell property, finding that extra money at the top end to stick it on, given that there have been freezes to stamp duty rates, the freeze brought in, or the changes brought in 2007 not 2007, back in September, are being kept by the current government, at least for the foreseeable future. And if you are disposing, you're disposing to that first time buyer, you're disposing to those individuals who are not second property owners, so this is going to be their principal property. You can probably recover 1,600 quid, and I'm not telling people to go out and overvalue their properties, but we're not looking at £16,000. We're not looking at £160,000. We're looking at relatively small amounts. We're just looking at it over a very large number of people.
Right. Okay. So there's no panic for property owners to go out and sell the property, and there's no. I mean, they can't really get around it anyway. But I don't think there's going to be a mass sell-off.
I can't see there being a mass sell-off. I think those that are going to sell are going to be the ones that are caught under the other regulatory conditions in that respect, and those that are just finding it too much or too hard or too expensive to run the property. The problem that I've seen with a lot of the clients that have come to me that have been looking to offload property portfolios or change them is that they have properties that are heavily leveraged and heavily financed. And this is where the issue comes in that, are you going to have enough money out of the sale of your property to pay off your financing and then pay the tax on top? And of course, finding an extra 1,600 quid might be the tipping point. You know, a lot of people that I've spoken to haven't had that, and they've just had to sort of resign themselves to the fact that they're going to be landlords for a little bit longer, and hope that all the prices and everything else come down. But realistically, like I say, I think that it's going to be the other areas that are going to impact the landlords more in that respect. I think for those that, for example, those that do cover the council tax rates, then you know the increase that increase, that a 5% increase into council tax rates is going to be a massive impact. The scrapping of the Section 21 evictions, that's potentially going to have a bigger impact. Any fluctuation that the interest rates and everything is going to have with relation to mortgages and other sources of lending is going to have more of an impact in that reality. I was speaking to somebody the other day whose mortgage repayments were 1,500 quid a month. Sorry, not 15,000 a month on their property. Now, if you can imagine that if you can imagine what can happen there with the interest rates, we're not looking at 1,600 quid of tax worrying them. We're worrying about interest rates shooting up and whether they'd be able to actually afford to manage the property.
That's £15,000 a month on a portfolio of properties.
No, this was on one property.
Just one property. They bought a property
on one property.
15,000 a month mortgage.
Yeah.
Which is what, 180,000 a year.
Yeah,
that's in some property, and
it's worth a fair few million. Let's put it that way.
Some kind of income, but I read the BBC said that 100,000 people a month are reaching the end of a fixed rate deal, and they're going to be in for a nasty shock, aren't they? Because rates could go up from say 1 or 2% up to 5 or 6%. I mean, are you finding that with some of your clients?
We are seeing that happening. It's happening from two aspects, because obviously we've got the residential side to compare to think of, which has traditionally been quite low, 1-2%, jumping up to sort of 4-5. Those individuals though that are looking at incorporating their property portfolios, they've also got a problem as well, because commercial rates have always been historically higher. And we are now seeing those commercial rates potentially doubling, you know, from sort of the 5-6% they were up to 10-11% potentially in some areas. And that in itself is enough for some people to turn around and, you know, you're sat there, if you've got a property portfolio, you're trying to look at these ways that you can save tax. But a lot of people don't function into it or don't think about is that you can't just put a residential property into a company, especially one that's got a mortgage on it, because it's probably going to be against the terms of your mortgage. Mortgage company would need to be notified, and you're then looking at trying to find alternative financing, which could be 2 or 3 or 4 times more expensive than the financing that you've got on it at this moment in time. So trying to I've had to have a fair few unfortunate and hard conversations with a few clients that have been looking to try and transfer small property portfolios into companies, and which are hard enough to begin with. But once you start looking at the commercial reality behind how these transactions work, and you start bringing in the financiers and everything else at this moment in time, I've just had a conversation with one client whose mortgage company was willing to let him take out a mortgage for £230,000, but wasn't willing to let him transfer a £77,000 mortgage from somebody else's name into his name.
Right.
So these are the problems that I think landlords are really going to be facing at the moment with the uncertainty of the marketplace. That doesn't mean to say, obviously, like I say, that they're not going to be paying more tax if they're selling their properties. They're not necessarily, you know, they're not going to be paying more tax on their on the income that's come in because of the freezing of the income tax bands in that respect, and that sort of stealth tax that's coming from there. And we've got to also remember that not only the income tax bands have been frozen, but also the IHT bands have been frozen as well. So these properties that are maturing and increasing in value, potentially, if they are then looking at having to pass them over to children, or they end up falling into part of their portfolios, gifts for reservation of benefits seem to be very prevalent at the moment, unfortunately. And so those landlords who are looking at passing You know, those mums and dads who are looking at passing their properties over to their sons and daughters and their children have to be very careful that they do it properly, and they don't end up getting caught under this gift with reservation of benefit issue, because then it will be doesn't matter if it's been done 7, 8 or 9, 10 years ago, it will be dragged into their IHT calculations if they were to pass.
So IHT being inheritance.
That's inheritance tax, yeah. So that's
so you're advising people on that as well, how to maybe shelter that or put their properties in trust if they've got portfolios. You getting a lot of that?
So that is something that is usually thrown around. It's very nice to think that we can just throw property into trust and it's done. But what a lot of people don't realize is that there's a lot of costs involved in that. And so if you're looking just at the family home, you have these problems where you are looking at the setup costs for the trust. You're looking at effectively the maintenance costs of those trusts, that being the paying the trustees. You're looking at the settlement costs. You're looking at payments out to beneficiaries and any income tax costs that may arise. And yes, it's a great way of being able to shelter assets in the trust and being able to put these trust assets in that can then value and protect yourself against that valuation. But it's one of those things that, again, referring back to sort of these property portfolio and corporation portfolios, is that commercially speaking and realistically speaking, it's only for those individuals that have got the money already. Unfortunately, you generally find that those people who've got 1 or 2 properties, or mum and dad trying to do something or whatever else, they're caught in the system, and it would cost far more in professional fees than any tax that they're likely to save. Let's put it that way. The other thing that I did really want to sort of touch on quickly with this respect is that there is the Making Tax Digital rules that are coming in, and I think that Jeremy Hunt had the ability to create a budget that could have taxed income where it lies, and created this dynamic future and this dynamic tax system going forwards. The government was sold Making Tax Digital, unfortunately, and it's something that they still are looking to press forwards with, and it was sold as a means of closing the tax gap. But the problem is that it's going to be impacting landlords, I think, a bit disproportionately. We're still waiting for a lot of the.
Why is that though? What's the difference?
So the main difference with what's happening with Making Tax Digital and what it's introducing is the reporting requirements on landlords. Now, a lot of landlords, potentially husband and wife landlords, the argument is there that there's 2 trades, but we haven't received any guidance on exactly how this is happening. The fundamentally what's going to happen is that landlords who are turning over £10,000, which is the majority of landlords out there, if you have to be honest with yourself, per year, per annum, will be required to file 4 quarterly returns with HMRC. They will then have to file a 5th sort of set of accounts, if I can call it that. And then they will have to file, after that, they'll then have to file their self-assessment as well on top of that. So we're looking at individuals who are submitting 1 return, 1 self-assessment, to having to now submit 6 documents, effectively 6 returns to HMRC for that same year. And the issue there's 2 issues. One, there's cost, because if you're getting an accountant to deal with it, or if you're getting an advisor to deal with it, or a third party to deal with it, it's going to be expensive. Secondly, there is that question of actually having the relevant information. Not wanting to insult anybody out there, but landlords are typically one of the worst people to get the relevant information off of when it comes to processing the tax returns, and either because a lot of it's being dealt with by a management company and they just sort of say, oh, the management company is dealing with it, but then trying to get the information out of the management company is like trying to pull teeth.
What sort of information would you need every quarter? I mean, the rents you've collected and
So you'd need
Interesting
to,
area.
yeah, you'd need to effectively know on a cash basis the rents that have been received, the money that's been deducted, the payments that have gone out, the repairs that have happened, you know, all the bills, service charges, insurance. I mean, the list goes on.
Mm.
And rather than providing that information once a year, you're now going to have to provide it 4 times a year. And then the set of accounts has got to be drafted up on an accruals basis at the end of the year, which has then got to be included as part of the tax return, which has then got to go in. So you're not saving yourself with anything. You're just having to increase these reporting functions. And for those landlords where they might have periods of people not being in their properties, you know, they're going to have these periods of time where they're effectively submitting these returns and keeping up on it with no income that's coming in to support the costs of actually having to produce the returns and everything else. So that is another cost that we're now looking at the landlords having to
Which is going to hit smaller landlords more than the big companies.
yeah, obviously it is. And the risk that you then have is I have quite a cynical, I suppose, view of how the revenue operate, and I think anybody who's been in tax as long as I have does that have that cynical view, especially when you are exposed to the tax investigation side of HMRC. Those of your listeners who have received nudge letters about the Let Property campaign or you know, anything along those
Yeah.
lines will know exactly what I'm talking about here. Uh, but it's a penalty exercise effectively, and increasing, you know, making it so that there are 4 5 or 6 returns rather
Yeah.
than one increases the chances that someone's going to miss a return,
Yeah.
which then means you can start charging penalties, and then you can start charging increased number of penalties for the more returns that have been missed. There are already enough landlords out there who fail or mistakenly don't include their income because they're, you know, taking their full mortgage deduction against the income, and they're sitting there going, well, I haven't earned anything. Well, that's just going to increase tenfold when MTD does come into play. So as I was sort of alluding to at the beginning, Charles, the main problem as I see it isn't so much the freezing and the stealth tax. Yes, that's going to impact everybody. It's going to hit everybody. It's mainly going to hit those PAYE individuals, but it's definitely is going to hit landlords who are being sort of hit twice in that effect because they're hoping that their trade profits are going up, and they also are hoping that their PAYE income's going up.
Yeah.
It's gonna hit them sort of double as hard. But the capital gains tax aspects, and the stamp duty and the dividends, I can't see that hitting them as badly, provided they are in that position to be able to weather the storm. What is really going to cripple most landlords, especially most small landlords, is the increased compliance loads and the increased costs and the increase to inflation and interest rates and everything else, all those areas that we don't really consider when we're thinking about letting out our property, but
Yeah.
have a massive impact on the amounts of cash that we can get in at the end of the day. And
Definitely.
you've
Yeah.
sort of got to make that decision really of going, is it worth holding the property as a long-term investment, even if it's going to cost me a bit now? And can I afford to shoulder that cost? Can I afford to absorb it in other areas? Or do I need to look at ways of potentially relieving myself of this asset or trying to liquidize some more of my assets or something else to be able to manage it? Property's always been a good area. And I think part of the reason why we've had such a property boom in this country is because other investments have never been as good. The issues with the issues that came into play with pensions and everything else just not keeping up with the rates that the property are going up, they became a very good way
Yeah.
to save for your future in that
It's
respect.
tangible. You can use leverage, as I say in my books, Borrow and Grow Rich. You can use leverage to buy a property, which you can't do in the stock market in the same way.
No, precisely. It's just, but at this moment in time, it is just that increased compliance that we have to think about and think
Okay.
slightly outside the box in that respect as to it's not just renting the property. It's not just how much money am I going to get a month out of it and how much is the mortgage going to cost. It's it's all these other areas. It's will I need to get an accountant into play to have to deal with making
Yeah.
tax digital when it comes in.
When is that likely to be, making tax?
So that's gonna come in from April 24. So
Okay,
we haven't got a long time.
that's definitely, that's not just a proposal, that is definitely coming in, you think?
It's been pushed a couple of times. They haven't said that they're going to be pushing it again. They might do. It's one of those things that may come in, it may not come in. As we are sitting at this moment in time, we are expecting it to come in. Don't,
Okay,
like I say, it's been pushed twice already. It might get pushed again.
I've seen a lot of people advertising software and schemes that you can use for helping you through making tax. I mean, are you going to be helping your clients with this? I mean, something obviously
Certainly.
that's
Yeah, certainly. Something needs to come into play. One thing that I would advise people though is that a lot of these companies out there that are advertising the Making Tax Digital Ready software, Xero, QuickBooks, Coconut, Sage, whoever they are, a lot of the guidance has not been provided yet. And a lot of these systems aren't actually in place or up to date. They are just sort of advertising their services as saying, hey, we are going to be able to sort of do this. You need to make sure you're doing it in a way that's MTD compliant. But before you charge out there and sign up to the first piece of software that says, hey, we can do this, have a think, have a look and see what it is that they are actually
right.
what they are actually doing, because as I say, there's a lot of guidance that hasn't come into play, and it's for, so if we come back to, as I was saying about husband and wife landlords, for example, it's technically two trades in that respect, because you're having to submit two tax returns and it's just a 50-50 aspect of the trade. So if they are earning £10,000, or they're triggering the limit at which they have to report, is it just one of them? Is it both of them? Are they reporting it as a partnership? Now, bearing in mind, partnerships are so far exempt from having to do Making Tax Digital, as are limited companies. It's just the sole traders and your unincorporated landlords at the moment that have to worry about it.
You said that again. So limited companies and partnerships will be exempt from
Limited
making
companies and limited and companies and partnerships at the moment are going to be exempt from having to deal with Making Tax Digital. They have their own reporting requirements. This is MTD is a way to allow the revenue to have a real time look on what sole traders and how sole traders and individual landlords are really operating in that respect. The reason they don't have to worry about it with companies or limited liability partnerships is because they have to file accounts, and and as far as an unincorporated partnership is concerned, it's not its own entity, but it's multiple trades effectively rolled into one to provide one trade. So that's not quite in place yet for the revenue, and again, there are some guidance that are missing in respect of that. But as I was saying, these husband and wife partnerships, effectively, because that's effectively what they are, well, we're looking at if that income being split 50-50. So the question that is out there, or one of the questions that's out there that we're looking for guidance for, is whether or not they're required to comply with MTD. Because is it one trade or is it two trades? Is it one trade earning over 10,000 or is it two trades earning under £10,000? If they do have to comply, who is it that has to do it? Is it going to be husband, or is it going to be wife? Is it going to be the major shareholder? Is it not, or the major owner of the property, or is it, is it not? And one of the key things to remember is that just because you are husband and wife and you're operating a property, it's not a partnership. If especially if there's only that one property, the revenue is never going to consider that a property partnership or a trading partnership. If you've got 5, 6, 7, 8 properties, then yeah, we can do something with that. But 1 or 2 properties in this respect, you're starting to walk a very grey line with regards to, does HMRC consider it a trade? Do they consider it an investment? Is it split equally between the 2 parties? What's going on here? And that leads then further into a question of, well, if you have got husband and wife, but they submitted a Form 17, so they've shifted the beneficial ownership, and so wife receives 90% of it and husband receives 10% of it, are we still looking at it being 50-50? Are we looking at it being 90-10? Are we, is it just the responsibility of the person who's got the larger beneficial entitlement to do the filing? So there are, in theory, it works, if I can say it like that. But in practice, you know, for those individuals who own the property outright, it's one person owning the property, absolutely fine. But when you get into a situation where there's multiple people, especially if they're husband and wife, or especially if they're fathers and sons and all that kind of stuff going on, there's
Still
going to be a lot of
unanswered
questions.
questions.
There's still a lot of unanswered questions, and considering that we are fast approaching the supposed implementation deadline, we're definitely waiting. And I, as I say, I do know that there are a number of these service providers out there who are going to do it, that their software is not up to date yet. Let's put it that way. They're advertising the services, but the software's not up to date yet. I would hold off, although it would be great to say, hey, everyone come on board and get MTD now. I think realistically, there's bigger things to sort of think about before the implementation of MTD, regarding whether or not it is something that individuals still, or whether it's just worth cashing in, going to an IFA and getting that money to sticking it into other investments somewhere, sticking into, you know, talking to your IFA and seeing what you can do in that respect to try and get money work for you in a different fashion.
Okay. That's really interesting, James. I think you see these things coming, and I suppose a lot of landlords are going to just leave it to the last minute and then suddenly start panicking, like they do at the end of January, maybe, when they come to us, I need my tax return. So really now, if you haven't, at the moment, you're doing your tax returns a year in arrears, I guess. So now it's going to be brought right up to date. But even now, I expect, go on, yeah.
Sorry, I was just going to say, so yeah, the first filing would be, I believe, June. So it's the first 3 months. So it will run 5th of April through to 5th of April, these filings effectively, and it's every 5th of April on a 3-month basis following the 5th of April in that respect. So that's when they've got to go. So from April 24, yes. Yeah.
So there's no need to panic just yet, but if you're out there and you haven't done your tax return, I think this is where they need to get things moving, because you don't want people coming to you and saying, you know, it's the 30th of January, can you find my tax return? I'm sure you get people doing that.
Oh, you do. You certainly do. You certainly do. It's, yeah, people have just got to be a bit more mindful. And I think this is I was talking to a number of colleagues the other day, and there's nothing we can really do as a populace in respect of, you know, these freezes and these changes and everything else. You know, we're employees, we're running our own businesses, we're going to get caught by this and everything. What we have to do is we have to start thinking differently about our taxes. So if you are an employee, what salary sacrifice or other occupational remuneration packages are your employer able to offer you that may help you reduce your tax bill? Are you able to subscribe more into your pensions? What can you, if you've got 3 or 4 or 5 properties, is there a better way of holding those properties? If you've got 1 or 2 properties, is there something else that you can do to effectively alleviate some of the pressure there? One other area just to touch on that I did scribble in my notes quickly was that I'm sure some people are aware of the corporation tax changes that are coming in from April next year, and this whole increase to 25% on taxes. Just as a reminder, that is 25% on tax in excess, or rather profits, I should say, in excess of £250,000. So those companies who are turning over profits of less than 50,000 are still going to be being taxed at 19%, which for the majority of, by the time you've taken out management fees and all other fees that you can potentially look at and costs in that respect, those incorporated, unless they have got a very, very, very large portfolio, are probably going to be looking at ways to see what they can do to reduce that down to that £50,000. And that's one of those areas that you can potentially look at. Well, what can your property company do for you? What else can it do? Can it invest into a pension? Can it offer you other salary sacrifice aspects? Do you have young kids? Can it start offering you childcare vouchers and all that kind of stuff to try and help reduce down the actual exposure that the company has to tax at that sort of marginal rate for when it drops over the £50,000. So it's a case of people just having to be a bit more clever with their money, I think, and a bit more clever and a bit more aware of what is going on. And rather than having the knee-jerk reactions to what's happening in the press, which they've got to sell papers. End of the day, the press have got to sell papers. It's as simple as that.
Yeah. It says here, unemployment rising, and yet there's spring budget warning.
Yeah.
Public sector borrowing. Yeah, they are. It's all doom and gloom, of course.
They've got to sell those, but it doesn't necessarily mean that it's bad news. I think it would have been more disastrous if they had aligned capital gains tax rates with income tax rates. If they had aligned, if they'd moved to that line and gone, right, we are now going to be charging 20, 40, 45% on capital gains, and reducing that 2,300 down to 600 or something like that, you're then looking at substantial tax rates, and I think then you're looking at a lot of people being underwater. But that's not really the situation we're in. People are going to have to pay a bit more money. Yes, that's just the way of it. Yes, there are things that we can do to try and mitigate that for a lot of our clients, but it comes down to those more real world impacts as well. Is that, yes, we can do, there's a lot of stuff that we can do, but is it actually going to be cost effective to do that for you? There are more things to worry about than tax at the end of the day. It's one of those areas that it's death and taxes. They are inevitable. But
penalties are not. Penalties
are certainly not.
Deal with things. So you get those brown envelopes.
Yep.
You open them, and I think the key is take advice from people like yourselves, from advisors, not wait until the end of the year and then start panicking. You've got to take advice, because if you can say to your client, well, you're nearing a different threshold, a higher rate threshold, and you're going to go over that, presumably by putting money into a pension scheme, you can reduce your taxable income. Is that correct? This means putting money into a pension scheme of some sort.
So from a tax perspective, yes, you can help. Subscriptions into pensions are very good. Those of your listeners who are very much up to date with their finances and keen investors and entrepreneurs, if you haven't got an IFA already, go out and get one. Go and talk to a couple, find one that you gel with really well in that respect, but find a good one. And a good IFA will get you to start using up your allowances properly before they start advertising you VCT, EIS, CDEIS, all these other tax saving investments. They're going to make you start using it properly. So they're going to make sure that you've put the full amount into your pension each year. They're going to make sure that you've topped up your ISA as much as you can do, so that you're getting tax-free benefit off of that. They're going to make sure that your interests and the dividends that you're receiving on your investments are as high as they can be without them being taxed, and they're up to their subsequent, before they then start saying, right, well, let's start chucking it into EIS or VCT or anything along those lines, which obviously now, there used to be able to set up an EIS and pretty much guaranteed you're going to get your return, didn't really matter, but the revenue like having that risk now, and they like us to be able to show that risk is there when we're going for the application in that respect. But I think my message is don't sit on it. Don't wait until next April or next June to jump on and say, right, I need to get this sorted. Don't wait until the end of the current tax year if you are thinking of selling. Don't wait until sort of February, March time, because ultimately you've got to get the property sold. And it's as simple as that. And if you're not going to be able to get that property sold before, searches and everything these days are taking months to come back. So it's even touch and go that if you were to approach a solicitor in January, that they'd be able to guarantee that it would be all sorted before the end of the tax year. So unfortunately for many who sort of sit around and go, oh well, I'll deal with it later, and then I'll deal with my tax return, I'll deal with it in February, or I'll deal with it whenever, you're going to run out of time.
That's true.
I think that being forearmed and forewarned is the best, and being able to sit down and go, right, well, actually, how much if I sold my property now, how much is it actually going to cost me in tax, in the, mortgage repayments, in everything else, what is it actually going to cost me? Because one thing that I do find with the clients that we do deal with when we do capital gains tax returns for them, when we do the property returns for them, is all of a sudden the tax is a lot lower than what they thought they did, because we've been able to sit down and talk them through and work out what capital expenditure and what deductions are allowable in that respect. And they're always pleasantly surprised. So I don't think I think keeping on top of it, knowing what's going on, and sort of acting at the right time is obviously the best thing to do.
And remember, the market has kind of slowed down a bit. It's becoming more of a buyer's market. So if you're trying to rush to sell a property in the winter, when the agent said this guy's looking for a quick sale, the agent tells the buyer that he doesn't represent, he's representing the seller, but he'll say to them, well, this guy's looking for a quick sale, you can put an offer in. So is it worth it when you have to maybe reduce your price by £10,000 to save a few £1,000 in tax? Maybe, as you say, if you have advice on this, they might think, well, no, it's not really worth it rushing through a sale. And then what do you do with that money? If you've got a load of cash sitting in the bank, losing value at, say, 10% a year, where do you put that money afterwards to give you anything like the income that you can get from a property? So I think, great, James, that's really good. I mean, I think the key there is perhaps not to worry so much about the implications of tax, although make sure you're up to date with it, but more about compliance and the Making Tax Digital rules that will come in from April 2024. That could really hit smaller landlords who are probably going to say, oh my God, I'm getting out. I can imagine some of them. But is there anything else you'd like to say, and any other points you'd like to cover?
I'm just having a quick look through what I sort of scribbled down, and I think I've managed to sort of get through everything. It's it is a complicated area, especially when looking at property, and we haven't even scratched the surface this morning as to the complexities that you can get into, and the tax planning opportunities that are available to people. But I think that you're absolutely right. It's be aware of your tax, understand your tax situation. If you haven't had a chance to speak to somebody, because it goes beyond your property income, it covers, tax affects everything in that respect. And so being able to sit down and making sure that you are operating tax effectively and tax efficiently within yourself, making sure that you are compliant. A lot of the Let Property campaign was driven by the settlement between Airbnb and HMRC. Airbnb didn't want to have to pay the tax, so they chucked their members under the bus. It is as simple as that. And what a lot of so Airbnb was approached by HMRC last year before, and effectively they were approached to say, you owe us a significant amount of tax. Part of the settlement, which resulted in a lower amount of tax being due significantly, was that Airbnb passed over all the details of the UK landlords who had been using Airbnb to provide services throughout the staycation period during COVID. Now, that's a relationship that is still happening at the moment, but HMRC are not adverse to going through land registry to see when properties have been sold or when properties have transferred hands. They're not, so they are, at the moment, the big thing that the revenue is doing is that they are cross-checking the tenancy deposit scheme against individuals to check that those individuals may or may not have over or undervalued their disclosures in their tax returns. So effectively what they're doing is they're checking that they're looking, seeing who's had it in there. They're looking at when the repayment's been made, looking at when the payment was seen in, and if they sit there and go, well, hang on a minute, it looks like we've got 5 or 6 years and they've only put in 4 years, or they've asked for a deposit of 10,000, a deposit of £2,000, and they've only been declaring, 500 quid a month or something silly like that through their tax returns, then you can expect a letter It's as simple as that.
Yeah.
You can expect that letter from the revenue, and it is a penalty exercise at the end of the day. I unfortunately had one client a few months back whose penalty was the same size as her tax bill. Ultimately, at the end of the day, because she hadn't acted properly at the relevant time, and we were looking at a couple of years, but it was still it got to the point where it was going to cost her more to challenge it than to actually pay it, but it was still a significant payment in that respect. So
if you've been letting out a room or a property under Airbnb and you haven't declared the income, then you could be in trouble there. And you should be declaring the income anyway. And you're allowed to let a room out for up to $7,500 a year,
yep.
tax free. But I believe you've got to still declare that, right? Or is it?
So yes, with property income, it needs to be declared. Strictly speaking, the revenue only care about income that's taxable. But when it comes to property income, then they like to know these things because it is a self-reporting aspect. And again, because it's a self-reporting aspect, it falls into penalties. If I can be as blunt as that, as again, penalty exercise. You report the wrong amount in your tax return, HMRC gets a whiff of that at some point. 9 out of 10 inquiries aren't open because the revenue's found out something organically. They're open because somebody has rung up the revenue and said so and so is getting more money or appears to be getting more money than what they think they are. You don't want to, for the sake of saving a couple of £100 in tax, you don't want to be playing that game with HMRC. There's a chance they might not find you, but ultimately at the end of the day, when you're looking at then having to go and getting it fixed, and when I have these conversations with my clients and they find out just how much an investigation will cost and the fact that it could go on for 2 years, 3 years, over a couple of £100 or a couple of £1,000, it's not worth it. Get the advice at the right time, get it from a competent individual, have a chat with a couple of people, and make sure that the person that you are speaking to understands your situation in that respect. I think that's one of the key things. There's a lot of advisors out there who will just try and shove you into a pocket with everybody else and will move on. Find someone who's actually willing to take the time to sit down, discuss, understand what your situation is, and then provide the advice rather than just saying, this is what I think we should do without listening.
Okay, James. How do people contact you if they want to get in touch with you?
So they can come to us through the website, or they can send an email to info@hawthorneconsultancy.com, or otherwise they can give us a call on 01442 974499. If you like LinkedIn, I am on LinkedIn. I'm more than happy to just to look for Hawthorne Tax Consultancy or myself, James Cannaford, on there. There's a lovely picture of me on there, so you should be able to find it. A little bit more clean shaven, I would say, in that respect. But yeah, ping me something through there. We are always happy to sit down and have a quick chat with someone to just understand the situation and try and work out what's going on. Yeah, more than happy to offer a sort of 20-minute, half-hour free consultation just to find out, because so often in the tax world we don't know until we've had the conversation, until we've sat down and run the figures. We don't know if there's anything we can do anyway.
Well, thanks very much for your time, James. I know you've got another meeting soon, but it's been really interesting. Key points there, declare things, do things on time, take advice and get an IFA, and watch out for these making tax digital rules coming in and extra compliance. So really good advice there, James. And if you want to get in touch with James, I'll put the details on the description. But it's all about managing your money and managing your life. And that's what I offer in my courses, which I'll put some details up there. There's a free course on how to get your finances in order, because in my days as an IFA, I always found that people who were in a mess with their finances were always either broke or going broke or went broke, no matter how much money they were earning. You've got to get control of things. And I think that's where you need people like James to help you with that. So thanks very much for listening. And I will see you again on the next episode of Money Tips Daily. Thank you very much. Bye for now.